The White House is panicking. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the Biden administration faces an imminent catastrophe, and with 5 months to go until the election, this is a critical time for voters because many of them begin to make their decision. And we continue to hear from the political elite that the U.S. economy is strong and robust on the back of the consumer and the labor market, but as of today, everything has changed. Plus, we have a sponsor for today's show. I'd like to welcome Bonsai International. You can find them on the NASDAQ under the symbol BNZI. And the reason you want to check this stock out is they're sitting right into a supply zone. There's huge buyers. And days ago, the stock jumped 68%. And I'm going to show you it's set to do it again. This is a chart in a company you don't want to miss out on. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline: as U.S. factory activity contracts as orders slide and output weakens. And for the current administration that is hoping to get a second term based on how strong they claim the economy is, all of a sudden we're seeing some major shifts in the survey data. And what this indicates, as we've been telling you, that we're headed into a recession. Now the early phases, as the Institute for Supply Manufacturing gauge fell 0.5 points to 48.7. Now this denotes a contraction anytime it's under 50, and this is the weakest in 3 months. And I want you to understand, if we were going to experience a soft landing or no landing scenario, then we should see something different in the data. Remember, we were told there was going to be a second half revival of the economy. We were going to come out of the first half and boom. And now the manufacturing sector is suggesting anything but. The Purchasing Managers Group measures of new orders slid 3.7 points, the biggest drop since June of 2022, to 45.4 May. The bookings index now stands at the lowest level in a year, suggesting demand across the economy is weakening. As a result, the ISM's production index slipped to near stall speed at 50.2. And so what we're seeing is further evidence that demand from the U.S. consumer is getting weaker and weaker. And what this means for the U.S. economy is likely by the time the election gets here, we'll be in an all-out recession. Of course, it makes perfect sense why the current administration is panicking, because they need the economy to boom, the Fed to cut rates, and inflation to come down. Do you think all of those are going to happen by the time we get to the election? Weigh in the comments below. Love to hear it, because here you can see new orders, and this makes a big difference in the economy, because when you see new order growth start to slow, we're looking at the Philly Fed data, because the Fed database does not have the ISM data in it, but we're going to look at continued unemployment claims in red, because one of the key things we continue to hear is the U.S. labor market is strong and robust, and now we're starting to see what is going to be a huge shift in a matter of months, as employers are going to find out they just don't need that many workers. And the key reason is new order demand is going down. And here you can see that it generally see this relationship headed into recessions noted by those vertical gray bars. You see here, of course, new orders slowing down, continued claims rising. You see that happen here again in the mid 70s, in the 80s twice, as we face back-to-back recessions, then into the early 90s, here again at the dot-com bubble, the global financial crisis, and now we've seen a bit of a plateau, at least if you believe the government data. But now with new orders shifting down, what it's telling us is that employers from the manufacturing side at some point are not going to have enough work to maintain their workforce, and that means hours are going to get cut along with jobs. And demand remains elusive as companies demonstrate an unwillingness to invest due to the current monetary policy and other conditions. And this is just the inaccurate view of the economy. The notion here is that companies don't want to buy things and order things because they're concerned about the economy. But that's not how the real world works. If a business is struggling to sell their inventory and not seeing a lot of people come in their store demanding it, they're not putting in orders for additional inventory. That's what we're actually seeing here. Has nothing to do with much else other than the weakening of the U.S. consumer. And these investments include supplier order commitments, inventory building, and capital expenditures. And why would you make commitments? Why would you build your inventory? Why would you invest in your company if you're seeing demand slow at a time when prices are rising? You're still being forced to give out wage increases. Employers are being squeezed at the margin here, and it's not a good sign for the economy, because what it's trying to tell us is consumers just cannot afford higher prices. The figures indicate U.S. manufacturing is struggling to gain momentum due to high borrowing costs, restrained business investment in equipment, and here's the key one: softer consumer spending. And in perfect sense, because what we're seeing is the U.S. economy run out of money. It's not just the U.S. economy. We're seeing it happen all around the world. I'll show you why that's happening here a little bit later in the show. But at the same time, producers are battling elevated input costs. And while the ISM's index of prices paid for materials and other inputs eased to 57 last month, still showing that prices paid are rising. It's still the second highest in about 2 years. And as we know, that means consumers just cannot afford higher prices. But something that is indeed about to gain momentum, that is the stock for our sponsor of today's show, Bonsai International. Check them out on the NASDAQ under the symbol BNZI. We talk about buying where the big players at. You can see them right here on the 30-day chart. All this buying underneath here. And notably, a few days ago, the stock just out of nowhere shot up 68%. We believe that that is likely to happen again as, of course, big players buy into the stock. Stay tuned to the end of the show, or check out the pinned comment or description for more information, because we look at the U.S. consumer, which is absolutely critical in the economy, that everyone said was going to power the economic engine going forward through the second half of the year. And I've continued to make the case that U.S. consumers are running out of money, and now all of a sudden it appears they've literally just flat run out all across the board. And here you see current new order index against advanced retail sales. And it makes sense when you think about it from the consumer perspective. If you have a business and you're not moving product, well, that means you're seeing your sales go down, as we note here in red. And if your sales are going down, then with a lag, what are you going to do? Cut back on your order of new materials and new products. And as that happens, well, those layoffs start to hit the manufacturing sector, and then eventually swing around and hit the services sector. Here we can note that retail sales has been on the decline. Now, while the Philly Fed said new orders are up, the ISM says no, that's going the other direction here, and quick. And of course, one of the issues we continue to see is prices paid remain elevated. And this is really an issue with energy prices. We know crude oil prices have gone back up in the short term, as is with gasoline prices. And this is squeezing consumers' budgets in a big way. They're seeing less hours at work. They're seeing their pay growth start to slow down, and they're getting hit very hard by higher energy costs, higher insurance costs. And you can note this doesn't happen every time, but frequently when you see rising prices against slowing advanced retail sales, in blue we're looking at, of course, the prices paid index for the Philly Fed, you know that it leads to an economic slowdown. Now, in 1994 that happened. Year I graduated high school. Here you see it going into the dot-com bubble. Prices paid rising, consumers can't afford it, eventually get into a recession. Happens again, mainly due to oil prices here going into the global financial crisis. You look at going into, of course, the last crisis here of the pandemic. What happened? Prices paid were rising, consumers couldn't afford it. We were headed in a recession to begin with. The pandemic just saved it. And now we're seeing that happen once again. And as we look at the ISM Manufacturing Purchasing Managers Index, there's a couple of things that do stand out. We see new orders contracting at a faster pace. So what this is telling us is manufacturers are not getting new orders in as fast as they want. And look at the backlog. This is contracting for now 20 months at a faster pace. And what's surprising is they noted that employment ticked up very slightly here. Now, they don't track hours worked in the ISM report, which would be fantastic if they did. But what happens at a manufacturing level when you have a workforce and you run through your backlogs and you don't have enough new orders to state them, well, that means everything in the labor market changes. For the Biden administration, that is the literally worst possible news. Again, as we're 5 months out from the election, and backlog is dwindling as we get caught up on new orders. That's from the machinery sector. New orders are not coming in as robust as backlogs are going down. That is a key point. Inflation continues to be a problem with pricing of raw material and interest rates. What that means, of course, is at some point, if they don't see demand increase, they're going to have to lay more people off. As you lay more people off, their spending goes down, and it starts to create a feedback loop into the economy. But it also means inflation is indeed coming down, because when people don't consume, well, you can only keep raising prices so much before your inventory gets out of control. Here you can see current new orders in blue leads downturns in the consumer price index in red. That's shown on a year-over-year rate change. You go back all the way here into the 70s, you see new orders go down, and then again with a lag, you notice that what we see as providers raising prices, and then when demand goes away, well, they price goes down, and you can see that relationship over and over is, of course, throughout history. So what we now know is inflation is coming down. But I previously said that the administration would love inflation to come down. They'd love the Fed to cut rates, but it would mean at the sacrifice of the U.S. economy. We're starting to see those signs now as key engine of the U.S. consumer spending are losing steam. And here's the problem. It's happening all at once. We noted why this would. I'll give you some charts to show you here in a moment. Is real disposable incomes, which is inflation adjusted, have risen only modestly over the past year. The savings rate now stands at a 16-month low, as households have mostly exhausted the extra pile of cash they squirreled away during the pandemic. And in turn, many Americans are completely trying to rely on credit and other sources of financing, such as those for-pay loans, and they're running out of runway on that too. We know that people are already in delinquency on those for-pay loans that they just took out months ago. And these factors help explain why real spending, that's inflation adjusted, which excludes the impact from inflation, well, that is what real means, it's inflation adjusted, fell in April with consumers shelling out less on cars, restaurant, and recreational activities. With the job market cooling, even Best Buy noted a change in recent months as shoppers switch to cheaper brands. And what it appears, and this is exactly what's happening, is the U.S. economy is running out of money. Now, many people believe it has everything to do with the president. It wouldn't matter if I was the president. That wouldn't change anything. This has everything to do with the Fed inverting the yield curve and the banks tightening lending standards. Because in a debt-based economy, you need new money to pay off the debt of the old and to create economic growth. And when the banks tighten lending standards, as we look here, the net percentage of commercial banks tightening standards to firms of all sizes shown in blue, you know when it's tight and they're starting to make it difficult to get a loan. It's anytime the blue line's above that horizontal block line. You show us against advanced retail sales. What do you see? Less money in the economy? Well, that means retail sales go down. That is not a good sign for the economy. We're now at a point, as that article from Bloomberg noted, that consumers have tapped out their savings. They're finding problems with high inflation, and they've got a ton of debt. They've run out of money, and so too is their spending. A slower labor market momentum will continue to limit income growth and push more families to exercise spending restraint amid reduced savings buffers and higher debt burdens. Factoring increased price sensitivity, household spending momentum was going to cool, and in a big way, because this Friday we get a fresh government jobs report which will offer more insights into the direction of the labor market. Of course, the Fed will have all eyes on this, as they usually are, because they're behind the curve. And we know that when the banks are not creating enough money to sustain growth, it has an impact on the labor market. Of course, all the pandemic stimulus fueled the economy for longer than most people thought. But you can see here when banks tighten lending standards, well, that certainly means the unemployment rate starts to go up. In this case, continued claims likely to head higher here in the months to come. And from that perspective, April's decline in consumer spending likely contributed to the welcome pullback in inflation. Of course, that is not really what the economy wants. You don't need a pullback in inflation as much as you need an increase in supply and an increase in wages to offset it. That's what we really need to see here. But yes, inflation is going to come down, but not in the way everyone wants. And yet it also may raise a question of how long the economy can hold up. And that is the question, how much longer do you think it holds up? Based on this ISM report, it says we're in the danger zone and coming quick. And that's not the only problem the Biden administration faces, as OPEC Plus now plan to restore output, spurs debate on oil trajectory. And here we can see the agreement reached in Riyadh on Sunday exceeded expectations in some ways, extending the so-called quote, voluntary output curbs from key members, including Saudi Arabia and Russia, well in the next year. However, it begins rolling back the supply reductions in October, earlier than some OPEC watchers had assumed. So again, we see that they're going to attempt to keep oil prices tight and keep them by keeping supply limited and keep those prices elevated for U.S. consumers. It's not a good sign. As the voluntary cuts by OPEC and its allies were in addition to an earlier group-wide agreement capping crude output at about 39 million barrels a day, which ran until the end of the year. And this is all in an effort to keep prices at 80 plus a barrel. Of course, this is going to be an accord that lasts through the end of 2025. We'll see if it makes it, because usually what happens is crude oil prices come crumbling down no matter what the output is. If you don't have demand from the economy for energy, well, you can't sustain prices unless they turn everything off. And here you can see the consumers getting hit by higher energy prices in the form of gasoline, as we look at advanced retail sales growth slowing against U.S. regular formulations. All gas prices in blue rising. You can see when that happens, well, usually it means we're heading into a recession or an economic slowdown. 2015, 2016, we were facing a globally synchronized recession. We started that again in 2018, but thanks to the pandemic, that was cured. And here we're seeing it again. Consumers are getting tapped out at every possible turn, and that's going to lead to less spending, less hours worked, and more people on the unemployment line. And with no surprise, that's why Treasury yields went down and bond prices went up, as weaker U.S. output gives the Fed more room to cut. What it's suggesting here as a big picture is when you see, of course, banks tighten lending standards and constrict the creation of credit, interest rates need to fall to spur the creation of credit. And if it doesn't happen and happen fast enough, well, that means everything's going to break in a big way. And here you can see something of an exact what is likely to happen. If we look at banks tightening lending standards again, you see they constrict the creation of credit, but what happens is interest rates need to come down. A system will bring them down, because if it doesn't, it means things are going to start breaking in a big way. Eventually that means the Fed's going to follow rates down and start cutting, and that's exactly what happens when you see financial conditions tighten. The monetary system eventually reacts to it. Despite the fact that nobody wants to own bonds and wants to be deeply short them, the monetary system will eventually drive rates down to create the money it needs. And if it can't do it fast enough, well, that's how we end up in a financial crisis each and every time. But something we are bullish on, that we think momentum is going to move behind in a big way, is the stock for our sponsor of today's show, Bonsai International. You can find them on the NASDAQ on the symbol BNZI, and they're transforming cold leads into engaged buyers as they get your content in front of your target audience and leverage deep analytics and insights to drive marketing decisions. And we think that's going to drive another big jump in their stock price of about 68%. And Bonsai develops essential marketing solutions for companies that want to grow faster, offering seamless integrations that increase customer value out of the box. Their consolidation mission critical subscale MarTech products with 3 key themes: acquisition, engagement, and analytics, and drive growth with our secret sauce, customer expansion through cross sales. And they indeed have some big customers such as Square, Hewlett Packard Enterprise, Thermo Fisher Scientific, Thinkific, Doodle, and Active Campaign, among thousands of others, and they have the results to back it up. 60% conversion rate, 3 times webinar conversions, and increased attendance rate, which we think you'll also love. Their stock setup here is market tools for data-driven marketers are driving demand for Bonsai's products, and you can see between content engagement from your ICP, because they help identify your target audience and help you reach them as well, making them a standout in their space. As Bonsai reports now first quarter 2024 financial results, and here's the big thing: they added over 230 customers in April. They also unveiled Reach 2.0, a major milestone release of the company's flagship marketing product. And they also have companies using Reach 2.0 such as Cisco, The Economist Impact, and CrowdStrike. And something we think is going to really be a big boom for your trading portfolio is Bonsai stock. Check it out on the NASDAQ under symbol BNZI. And I want you to see that the price came down deep in the supply zone, and buyers stepped in a big way between 16 and 20 cents a share. And they have snapped this up. In a matter of a few days ago, the stock just jumped 68%. And you can see right here, based on the volume profile over the last 10 days, I showed you the chart on 30 days earlier, that buyers are eager to buy the stock, setting up another big move, what we think could be 68%, making Bonsai International an opportunity you definitely don't want to miss. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.